Every time you see a technical indicator giving out signals, have you ever wondered, how reliable is this signal really? Traditional indicators are like products without quality control. They tell you the result, but never prove their reliability. Today's strategy brings statistical significance testing from statistics into the trading signal generation process. Every signal must prove its statistical validity. Welcome to the FMZ Quant Strategy Selection channel. We focus on discovering the most practical quantitative strategies in the commodity futures field. In the world of technical analysis, almost all indicators do the same thing: calculate values and give signals. But there is a fatal problem that is widely ignored. The statistical validity of these signals has never been verified. When RSI shows oversold, how do you know this oversold will actually bounce back instead of continuing to drop? When price breaks through a trend line, how can you tell if it is a real breakout or a fake one? The multi-layer statistical regression strategy was born to solve this core pain point. It is not satisfied with simple numerical calculations. Instead, it equips every signal with multiple statistical verifications. Only signals that pass strict mathematical testing are allowed into trading decisions. This effectively solves the problem that traditional indicators cannot verify their effectiveness from a statistical perspective. The core innovation of the multi-layer statistical regression strategy lies in building a three-layer statistical verification system. The first layer is short-term cycle regression, designed to capture immediate price trend changes. The second layer is medium-term cycle regression, used to confirm trend continuation. The third layer is long-term cycle regression, providing the big picture trend background. Each layer performs complete statistical analysis, including R-squared values, correlation coefficients, and slope significance testing. Only signals that pass strict statistical tests are considered valid. More importantly, the strategy introduces an ensemble weighting mechanism. It fuses the three time levels according to set weights to form the final trading decision score. At the same time, the strategy adds prediction accuracy backtesting verification. By comparing historical predictions with actual movements, it evaluates model reliability. It also designs three-level verification standards to adapt to different market volatility characteristics. This multi-dimensional verification ensures high-quality signals and effectively avoids false signal problems of traditional indicators. The strategy also designs a signal strength grading system that can distinguish strong signals from basic signals. This lets traders adjust position sizes based on signal quality, combined with daily loss control mechanisms to achieve a complete quantitative trading system from statistical verification to risk control. The strategy parameter design reflects the core concept of multi-layer statistical analysis. Three regression length parameters form the time framework foundation of the strategy: short-term regression length, medium-term regression length, and long-term regression length correspond to different market rhythms. This layered design can capture both rapid changes and long-term trends simultaneously. Statistical verification parameters are the quality control core of the strategy. The minimum R-squared threshold determines the explanatory power requirement of the regression model. Minimum slope significance ensures trend strength reaches tradable levels. Minimum correlation ensures the linear characteristics of trends are obvious enough. Validation backtest period and prediction time range parameters are used for forward-looking analysis and prediction accuracy verification of the strategy. Ensemble weight parameters reflect the strategy's judgment of the importance of different time cycles. The highest short-term weight reflects commodity market sensitivity to momentum. Medium-term weight and long-term weight settings provide necessary trend confirmation. In risk management parameters, position size percentage controls risk exposure for single trades. Maximum daily loss percentage sets a protection line for extreme situations. Signal confidence threshold is the minimum requirement for signal quality. The introduction of signal strength grading function, through enabling signal strength grading switch and strong signal threshold settings, lets the strategy handle different quality signals differently. Strong signals get higher confidence requirements and larger position allocation. These parameters together form a strict statistical screening and risk control mechanism. The core of the strategy is a complete linear regression statistical function. This function not only calculates regression lines, but more importantly provides complete statistical verification data. The function calculates corresponding combinations of x and y through accumulation, then uses least squares method to calculate slope and intercept. The key is also calculating correlation coefficient R and coefficient of determination R squared simultaneously. These two indicators directly reflect the reliability of the regression model. The function finally returns 5 important values: Current regression value represents the regression line position at current time point. Slope shows trend direction and strength. R-squared and correlation coefficient provide statistical reliability verification. Predicted regression value gives price expectation for future time points. These 5 outputs provide complete mathematical foundation for subsequent signal verification and decision-making. The statistical significance testing function is the essence of the strategy. It provides 3 strict levels of verification standards. The relaxed level reduces statistical requirements by 20%, suitable for capturing weak but effective trend signals in choppy markets. The normal level uses default parameters. The strict level increases requirements by more than 20%, specifically used to identify the strongest trend signals. This graded verification mechanism allows the strategy to flexibly adjust signal sensitivity in different market environments. It will not miss important opportunities and will not be misled by noise signals. Signal generation is the most precise part of the entire strategy. It fuses regression analysis results from multiple time cycles into unified trading decisions. 3 time levels each perform independent regression calculations and statistical verification. Short-term level uses normal and strict verification levels. Medium-term level uses relaxed and normal verification levels. Long-term level uses relaxed verification level. This layered verification strategy ensures capturing market changes at different timescales, while adjusting signal quality requirements based on time cycle characteristics. The backtest verification function calculates prediction accuracy by comparing historical actual price changes with predicted slopes. When accuracy data accumulates enough, it returns average accuracy, otherwise returns default value. This verification mechanism provides quantified basis for the strategy's practical reliability. Confidence calculation is the core innovation of the strategy. It cleverly fuses 3 dimensions: signal consistency, statistical confidence, and historical validation accuracy. First, it converts statistical verification results from 3 time levels into directional signals, then gets ensemble scores through weighted summation with preset weights. This score directly reflects the consistency and strength of multi-time cycle trends. Basic consistency scoring measures the degree of coordination between time cycles. Statistical confidence uses weighted average calculation of R-squared values from each level, reflecting the overall explanatory ability and reliability of regression models. Validation confidence directly uses prediction accuracy numbers obtained from historical backtesting. The final overall confidence formula gives 50% weight to statistical confidence, reflecting emphasis on mathematical model reliability. It gives 30% weight to consistency scoring, emphasizing the importance of multi-time cycle coordination. It gives 20% weight to validation confidence, ensuring the strategy is practical verification foundation. Signal strength grading mechanism judges whether it is a strong signal by comprehensively evaluating whether overall confidence exceeds strong signal threshold and whether short-term or medium-term levels pass strict statistical verification. This grading allows traders to adjust position sizes based on signal quality, achieving more refined risk management. The strategy execution part reflects the importance of refined risk management in quantitative trading. Position management uses dynamic adjustment mechanism, calculating final trading positions based on signal strength and overall confidence. Strong signals get larger position allocation. Weak signals use conservative positions. This lets the strategy increase investment when certainty is high and be cautious when uncertainty is large. Daily loss tracking mechanism monitors current day loss percentage in real time. Once it exceeds preset limits, all trading stops, forming an important risk control barrier. Trading execution logic designs 2 sets of entry conditions: basic and enhanced. Basic conditions have lower thresholds to capture more trading opportunities. Enhanced conditions require stricter, multiple verifications to ensure high signal quality. This layered execution mechanism balances trading frequency with signal reliability. The strategy also designs initialization entry mechanisms and emergency risk control measures, forming a complete trading execution system. When there are no positions, it uses lower thresholds for exploratory entry, avoiding slow strategy reaction when markets turn, while using smaller positions to control initial risk. Daily loss control mechanism serves as the strategy's final safety valve. Once triggered, It immediately stops all trading and forces position closure. This mechanism provides key protection in extreme volatility environments of commodity markets. The entire execution logic achieves full process automated decision-making from signal identification to risk management through organic combination of signal grading, position adjustment, and risk control. The visualization design fully reflects the multi-layer characteristics and signal strength grading concept of the strategy. 3 regression lines use different colors and transparency to represent statistical significance. Verified lines display in bright colors. Unverified lines display semi-transparent, letting traders intuitively identify which time cycle trends are most reliable. Background color displays in grades based on overall confidence. High confidence shows dark background. Low confidence shows light background, forming progressive visual feedback to help traders feel signal strength. Signal marking system uses different sized triangles to distinguish strong signals from basic signals. Strong signals use large bright triangles. Basic signals use small semi-transparent triangles, letting traders quickly identify different levels of trading opportunities. The multi-layer statistical regression strategy shows good adaptability in different market environments. In clear trend initiation phases, when multi-time cycle regression slopes are in the same direction and statistically significant, the strategy can effectively identify main upwave or main downwave initiation signals, providing traders with high-quality entry timing. In choppy markets, the strategy can effectively identify true and false breakouts through graded signal strength mechanisms, avoiding being misled by frequent false signals. Relaxed verification standards capture weak trends. Strict verification standards confirm real breakouts. When using the strategy, you need to avoid using overly strict verification levels during extremely low volatility periods, as this easily misses weak but effective signals. At the same time, parameter settings should be adjusted according to different trading instruments' volatility characteristics to achieve optimal balance of signal quality and frequency. In advanced applications, traders can combine ensemble scores and confidence for more refined graded position management, dynamically adjusting position sizes based on signal strength. They can also use the strategy's built-in prediction accuracy verification function to evaluate strategy effectiveness in current market environments, providing data support for strategy optimization. Examining this strategy from strict quantitative analysis standards, we can see its performance across multiple dimensions. In strategy completeness, it performs excellently. From parameter settings to signal generation to risk control and visualization, it forms a quite complete trading system. Especially the statistical significance verification mechanism and multi-time cycle fusion design reflect deep mathematical foundation. In risk management dimension, it also performs well. Dynamic position adjustment, daily loss control, signal strength grading, and other multiple protection mechanisms work together, forming a 3-dimensional risk protection system. In adaptability, the strategy can adjust sensitivity in different market environments through 3-level verification standards and graded signal processing. This flexibility is especially important in commodity markets. Understandability is a major highlight of the strategy. Although it involves complex statistical calculations, the overall logic is clear, and each module has distinct functions, making it easy to understand and modify. Innovation is reflected in expanding traditional linear regression into multi-layer statistical verification systems. This approach of applying rigorous statistical methods from academia to actual trading has strong originality. Practicality has some shortcomings. The strategy has high parameter sensitivity and needs careful tuning for different trading instruments. Overall, this is a strategy that quite successfully combines statistical theory with trading practice. Although there is room for improvement in practicality, its innovative multi-layer verification mechanism and rigorous mathematical foundation give it the potential to become an excellent quantitative strategy.